Okay, let's have a look at the week that was, and we'll look at the week that will be. This week, what I want to do is introduce you to some new data sources and some new things to look at. We're going to go into a number of different reports, and there's going to be quite some time spent with inventories and with different shipping indexes in terms of price and shipping indexes in terms of freight. And we'll see that that is sort of agreeing with what we saw in the CPI numbers this week for the month-over-month change. Month-over-month, very, very constructive. So, I don't know that that takes 25 basis point hike off the table for May. The consensus is 50 basis points, and I sort of think that, 50 basis points is more likely than 25, but that doesn't mean 25 has zero probability. I think it still has a significant enough probability, probably a 40% probability, with 50 basis points being 60% probability. And that's really only because Bank of Canada did that this week. 50 basis point hike on April 13th, plus balance sheet runoff beginning April 25th. And we'll read the Bank of Canada statement shortly. Let's have a look at the change in yields. There's only, yields only dropped at the 2 and the 3. But when I had done that video about the 2-year predicting the federal funds rate using regression, I had concluded that the 2-year was probably well ahead of where the Fed was going to be, and that spread between the Fed funds rate and the 2-year was too high. That I thought that the 2-year was probably at that point undervalued, and there is some price appreciation on the 2-year, and the 10-year gave way a little bit more. Steepening, we can see here, steepening across the entire curve, except the 3-month to 5-year. That's not much to pay attention to. The 3-month of the 5-year, the 3-month of the 10-year, all still at about 200 basis points. This is the 3-month to the 10-year, 204 basis points. But steepening all the way across the curve, and no part of that curve is inverted. That's all gone away. So we have upward sloping curve all the way. The 5 to 10s, is still positive, but you could call that flattish. Same with the 10s to 30 range. That's still fairly flat. I would expect more upward pressure on the 10-year without the 30-year really following through. So I think the 10 to 30 might invert, but that's not really a big deal. Inversion, usually we're concerned about the short end of the curve with, usually the 10-year. And we have nothing here. We look at, since the beginning of the year, how rates have changed. We've already got a 25 basis point rate change in the Fed funds rate. It's moved quite a lot, and that's already financial conditions tightening, because all other rates are derived from this curve. So all other lending rates are a function of this curve, not necessarily a function of where the federal funds rate is going to be. The market's already moved way ahead. So for them to slide 50 basis points into a big open hole, it's like a big wide doorway. You can walk that right through without, chipping the paint on either side. It sort of lends a good argument for saying, look, the market's already way ahead of you. 50 doesn't change anything. So I think there's probably a higher likelihood than not of 50, but I'm not taking 25 off the table. I'd probably be 60% on a 50 basis point hike and 40% on a 25. Last week I was 55-45, more 60-40, only because Bank of Canada's gone ahead and done it, and the fallout was meh. It was widely expected, and it was meh. So if 50 basis points are widely expected, why not take it? If you're going to get to 1.75 to 1.9% by year end, I don't know that there's anything wrong with front end loading it, and you can then relax on the back end. However, inflation month over month was constructive. Everything seems to be moving in the right direction, which we'll see as we go through the data. Let's read the Bank of Canada statement. This here, we had a small move in the CAD versus the US on the announcement, only because it was it was expected. It was a small move, but then it gave up that move going into the end of the week. I do expect the Canadian to be strong going into the end of the year. So any U.S. weakness, the Canadian will really, I think, outperform. And I think one bank had put a target of 120 to 123 by year end. I think we're sitting at 126.11 right now. I seem to agree with that. I don't think that is unreasonable for that. So I still maintain my long position on the Canadian against the short on the U.S. Let's check out Bank of Canada here. Okay, I'm on the Bank of Canada site. Here is the statement. The Bank of Canada today increased its target for the overnight rate to 1%, with the bank rate at 1.25% and the deposit rate at 1%. The bank is also ending reinvestment and will begin quantitative tightening effective April 25th. Maturing Government of Canada bonds on the bank's balance sheet will no longer be replaced, and as a result, the size of the balance sheet will decline over time. So this is called balance sheet runoff. Is you're not selling bonds to reduce the size of your balance sheet. You're just saying, look, as soon as they run off, that's it. We're not going to rebuy. So a price insensitive buyer is now out of the market. Talks about the ongoing problem with Ukraine. It says here, supply disruptions resulting from the war are also exacerbating ongoing supply constraints and weighing on activity. These factors are the primary drivers of a substantial upward revision to the bank's outlook for inflation in Canada. More of these supply constraints. And if you want to continue reading it, it just has more information on where it thinks the Canadian economy is going to grow to. The bank forecasts Canada's economy will grow by 4.25% this year, slowing to 3.25% in 2023 and 2.25% in 2024. Inflation is 5.7% above the bank's forecast in its January monetary policy report. Inflation is being driven by rising energy and food prices and supply disruptions in combination with strong global and domestic demand. So they're giving a nod to both. Hey, look, we got supply disruptions, but you also have strong global and domestic demands. Core measures of inflation have all moved higher as price pressures broaden. CPI inflation is now expected to average almost 6% in the first half of 2022 and remain well above the control range throughout this year. It is then expected to ease to about 2.5% in the second half of 2023 and return to the 2% target in 2024. So not till the end of next year, the second half of 2023, next year, does it expect it to ease to about 2.5%, but remain elevated and work its way down. So we'll look at the most recent inflation report, and we'll look at trends in shipping in terms of the costs and volumes, and we'll see if that seems reasonable. Here are our real yields. We're close on the 10-year. We're close to turning over to a positive real yield on the 10-year. Real yields on the 30-year and the 20-year have both increased as well. All real yields have increased. And if we look at inflation expectations, break-even rates here, they're somewhat flat. These are small little moves that I wouldn't read too much in there. Somewhat flat, which is good. CPI month over month was constructive. If you look at a going forward rate, if you take the month over month and you say, okay, well, let's say that is the new month over month, that it'll stay at that rate. On a non-seasonally adjusted basis, this is core CPI. We're looking at 4.28% on core CPI using the month over month, or 3.97 seasonally adjusted. That's a forward annualized percentage. And if you're assuming a certain rate per month, whatever it happens to be, 1 plus, and we'll just say it is whatever the inflation is, it is to the power of 12 minus 1. This is a 1 month rate, because the prices go up 0.3% this month and 0.3% next month. Well, that 0.3 is on the 0.3 that already went up, so you would power term it and not just multiply it by 12. So on a forward basis, annualized, yes, still elevated, right around the 4% range, but much lower than the core inflation rate that we saw, which was, it came in below expectations, by the way, but it was still elevated. Wells Fargo believes that with this last inflation report, we have seen peak inflation. We're going to dive into the CPI report, and we're going to pay attention to a particular sign. And as I scroll down, I want you to see how many times you see that sign. Maybe you'll agree with Wells Fargo as well. ECB this last week also is bringing forward the end of its bond buying to the end of Q3. I should have mentioned that on the previous screen, but when I was writing this out, I said I forgot to mention the ECB. Let's put it here. Mortgage applications we get them every week. So week over week, this last week was down 1.3%. That sounds pretty bad, right? But you have to look at the refinance index and the purchase index. And the refinance index went from 1166.3 down to 1109. That's a drop of 4.91%. For refinancing, as here's your 30-rate mortgage, it had hit a high of 5.25, so it is coming back a little bit, but this is still over the 5% range. That's not surprising. You don't go to the bank and say, "Listen, I would like a 5% mortgage to replace my 3% mortgage, please." You don't refinance on the way up. So if you can recall from level 1 mortgage-backed securities, we know that when interest rates rise, prepayments slow down because refinancing primarily drops. That's not surprising. Look at the purchase index, went from 258.1 up to 261.8. That's an increase of 1.43%. So when we see mortgage applications are down, well, hang on, mortgage applications for what? You apply for a mortgage when you want to refinance your existing mortgage, and you apply for a mortgage when you want to purchase a home. The refi index is down, the purchase index is up. Not only that, inventory, housing inventory up 9.3% in March, month over month. It's fairly normal that as you go into the spring, supply begins to increase. But that's a good sign. We're going in the right direction. However, it is still down 13.4% year over year, meaning last March, at this particular time, there were more, for March. Last March, there were more listings last year than this year. So housing inventory is still low. However, it is moving in the right direction. Purchases are not negative when we're looking at the mortgage applications. This is not surprising. That is normal, and even at 515, we still have positive increase on the purchase index. Let's look at CPI. Okay, here is our news release from Bureau of Labor Statistics. Again, all the links you should find in order in the description box. Let's just go down to the chart here. And what we're looking for, here's all items, but we want all items less food and energy. We want the core. And here we are for March 22. If we look down that column, there's 0.3. That's month over month. Look, the previous month was 0.5, 0.6, 0.6, 0.5, 0.6. This is now 0.3. So yeah, it's up 0.3%. But it's not up 0.5 or 0.6. This is, this was a big push to that number. We're at 0.3. It is beginning to moderate month over month. The year over year, we still have the base effects in there. So the year over year looks quite big, but when we look month over month, if you take that 0.3 and you annualize it, you get the rates that I showed you on the previous screen on a going forward. That if we think that this is going to happen on a going forward. Do we have any basis to believe that this is more than just an anomaly? We have to dig into the data itself. So let's scroll down till we hit the tables. And here we are. We're looking for all items less food and energy, which is over here. And we're looking at this final column here, which is February, we're just looking month over month, February 22 over March 22. If you're looking year over year, it looks like a big number, but if we're trying to find the direction that something is going. You want to look at, the most previous numbers you have. So month over month gives us some direction. And so we're down here. And what we're going to do is we're going to look for negative numbers here. Commodities, -4. Look at this, 3.8 down. Used cars and trucks down 3.8. Even new vehicles, only 0.2, which isn't so bad. So you got a negative number down here, motor vehicle maintenance and repair. Airlines, 10.7%. That's significant. Airlines and hotels are up, even though the capacity utilization is down. They're up only because they're saying if we're going to be profitable, we got to charge these numbers. Let's just keep going. Now we're at this was a high level view, right? Let's dig deep into this. So we're going to start again here. This is all items food. We want to go past all the food and all the energy. We're still on food. We're still on food. We're on energy. There's all items less food and energy. Now here's at the granular detail level. Let's go across to this column and let's look for negative signs. There's one there, there's one there. Let's keep going. You're gonna see it show quite a bit soon. There's a negative there, negative, 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 negative. Let's keep going, negative. There's another one, another one, another one, another one. And look at all the negative signs, negative, 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 right? Look at a whole bunch more negative signs down here. Bunch of negative signs. So let's keep going. Look at all the negative signs. Look at them all. Negative, negative, negative. Look at here, keep going. More negative signs, negative signs. This is the first month that has had that for a while, that has had that many negative signs in there. You can go back and look at the data for a while, but to find that many negative signs in there. So I'll leave that to you to look at more if you want. But as we said here, the month over month is very constructive on the CPI. A lot of prices are starting to give way. So I look at that and I think, I wonder if if we can glean anything, if we look at inventory levels and shipping rates, not just shipping rates, but also freight volumes as well. That if I didn't know what the CPI was and I looked at inventories and I looked at shipping rates and shipping volumes, could I have guessed that that prices would have come down a bit? Yeah, it is confirming each other. So it seems that that supply bottlenecks are beginning to improve. So we'll look at some of that data there. But on a going forward basis, this is, I think, what Wells Fargo is sort of getting at when they're saying we have peak inflation. So the next reading is going to be very interesting, but this is the reading that's ahead of the Fed. Are they going to be swayed by all those negative numbers? Or are they going to say, well, we're moving in the right direction, but one data point does not make a trend? So will they go with 50? And if the next inflation report has a whole bunch of negative numbers in there as well, will they then drop to 25? Or will they err on the side of caution and say, well, it looks like it's going the right way and we don't want to mess up the economy. We really don't want to mess up asset prices. We don't want to mess anything up. We just want inflation to go down. And if it is going down, should we be more cautious? Yeah, do some balance sheet runoff. You don't need an $8 trillion balance sheet. Do some balance sheet runoff, of course, but do we need to front end load all this stuff, or can we go with 25? I think that's why I'm not ready to put 0% on 25 at this point, but I'm still, 60% on the 50, 40% on the 25. Okay, let's move on. All right, here is some highlights from last week's economic calendar. GDP now, which we were introduced to before as of April 14th, is at 1.1% for Q1. That is the Atlanta Fed that puts that out. Industrial production, 0.9%. These are percents. I just didn't feel like writing out all the percent signs. 0.9% versus a forecast of 0.4%. This is for the month of March. Not only that, February was revised from 0.5 up to 0.9%. That is all constructive. That is all good. Empire State Manufacturing, really big, 24.6. It's a diffusion index. Anything over 0 is an expansion. 24.6 versus a forecast of 0.5. And this was for April. Anything with the set of eyeballs here, we're going to take a closer look at. So we'll take a closer look at Empire State Manufacturing, because it's made up of, any diffusion index is made up of sub-indexes. So we want to look at where the sub-indexes happen to be for, this could be hiding some bad news. Motor vehicle sales, this is for Canada, 103,000 versus 94 for the month before. And this 103 was for February, 94 was for January. That's constructive. With the auto industry, it is clearly a supply issue. It's not a demand issue. Car companies are selling almost every single car they can make. And most dealerships are on allocation, meaning if they order 25 vehicles, if they get 9 or 10, that's it. Most of that is sold, before it hits the lot, and the rest is sold in the first week. So there is no issue selling the vehicle, it's getting the vehicle. But we are getting some indications that it is getting better. Levels of inventories for vehicles are starting to rise, and we're going to look at it when we look at business inventories here. Increased 1.5%, and this is for February, versus a forecast of 1.3. So it had a higher increase. And the previous month was revised from 1.1 up to 1.3. And it's broken down into a number of sub-indexes as well. Manufacturing inventories rose 0.6, wholesale inventories rose 2.5, retail rose 1.4, and autos rose 0.9. All of those going in the right direction. Now, by no means is there plenty of inventory out there. There is still very low levels of inventory, and if you look at the inventory to sales ratios, they're still quite low. But this is all going in the right direction. Inflation is still high, but it's all going in the right direction. I shouldn't say all, but really the headline, the core itself being up only 0.3, heading in the right direction. Industrial production heading in the right direction. Yes, this is a low level, but heading in the right direction. Consumer sentiment, 65.7. Typically, you would say, but that is very, very low. The expectation was 59. The month before was 59.4. We're at 65.7. That is going in the right direction. Retail sales less autos up 1.1%. The forecast was for 1%, and there was a revision to the previous month from 0.2 up to 0.6%. Here's the little blip. If you take retail sales less autos and less gas, it was only up 0.2% month over month. With inflation up 0.3% month over month, retail sales up 0.2%. The real volume is down. There was a revision to the previous month from negative 0.4 to negative 0.1, so that is, that's positive and in the right direction. 0.2, still greater than 0, still positive and in the right direction, although if we adjust for the price level, for retail sales, you would adjust for the price level because it is the price of everything. That is a price index. You would adjust that for a price index. People's incomes, you don't adjust for a price index. You adjust for a cost of living index because they can spend their money on whatever they choose. But if you're just looking at retail sales, since it's everything, you would adjust that by a price index. And on a real basis, yeah, that's a little bit of a problem. It would come in negative. Okay, this is available on the New York Fed's site. The link is in the description box. Let's read just the first opening paragraph, and then we'll look at some of the sub-indexes here. Business activity picked up markedly in New York State, according to the firms responding to the April 2022 survey. The headline General Business Conditions Index surged 36 points to 24.6. New orders and shipments grew strongly, and unfilled orders increased. Delivery times lengthened, though at a slower pace than in recent months, and inventories rose. Labor market indicators pointed to a small increase in employment and the average work week. The prices paid index hit a record high, and the prices received index remained elevated. Plans for capital and technology spending were solid. Looking ahead, firms were significantly less optimistic about the 6-month outlook than in recent months. So on a going forward basis, optimism is down. However, the activity over the month is showing solid expansion. It's a diffusion index. As we can see here, anything over 0 is expansion, anything under 0 is contraction. In the particular index or sub-index that we're looking at, we're way up here above 24. So if you draw a line across, you can see that it is in the upper range of all of the previous observations that we have seen. Let's look at the sub-indexes. General business conditions, in April, we see is 24.6. That's an increase of 36.4. So not only is this strong, it's significantly stronger than March. March was negative, so not only did we go from contraction to 0, but into expansion on that index. New orders for April, 25.1. So that was an increase of 36.3 month over month. Shipments, 41.9 increase, and this is above 0. Unfilled orders, 4.2. We're at 17.3 in April. So the number of unfilled orders has increased. Delivery time has dropped month over month, but still at 21.8, which means delivery times, they still expect that delivery times are going to take longer, that they see a longer lead in delivery times. However, that is shrinking. 10.9, but still elevated. We want to see it, get closer to, the zero line. Inventories, 13.6, meaning inventories are expanding, although at a slower rate. So if you think about it in terms of derivatives, the derivative of it is changing, is slowing down. Negative 7.9. Prices paid. Look at this, 86.4. On this index. That's what we read in the opening paragraph, all-time high. That is your input costs. Let's have a look at the prices received. Still elevated. However, it's going in the right direction. It is moderating from the month before. So even though prices received are still going up, they're going up less so. Pullback of negative 7. So that's heading in the right direction, although this is still rather elevated. Number of employees, here we have for April 7.3, signifying expansion in the number of employees. However, not as much as the month before, so it is moderating, but it's still above 0, so that's still positive. In fact, all these indexes are above 0. And the average employee work week, they see the work week getting longer, 10 versus 3.5, so an increase of 6.5. So there's Empire State Manufacturing Survey. Overall, positive. All right, let's look at manufacturing and trade inventories. The report for February, our next release is May 17th, and that will give us March. We can see here total business inventories to sales ratio. We're still quite low. We're not in the area of 2015, 16, 17. But if you look back at 2013 into mid-2014, sitting around 1.3. We're just a little below 1.3, or about 1.2. 1.27. Let's go to the tables and see what we have down here. So here's our total, this is adjusted and not adjusted total business inventories. It breaks it down into manufacturers, retailers, and wholesalers. And if we look at, this is inventory to sales ratio February 2022, 1.26. You go back to 2013, 2014, it pretty much hung out in and around the 1.3, 1.26. That's not so bad. It was 1.33 last February. January is 1.25. Now we're 1.26. For manufacturers, 1.45. Fairly constant month over month. 1.13 for retailers, and for wholesalers, merchant wholesalers, we had that little tiny tick up, 1.2 to 1.21. This gives us inventories total, again, manufacturers, retailers, and wholesalers. And we'll look at inventories here, February 22 over February 21, year over year. Total business inventories up 12.4%, manufacturers up 9.7%, retailers up 7.3%, merchant wholesalers up 19.9%. This is on an adjusted basis. Unadjusted is fairly close to that as well. If you're just looking at month over month, here it is right here. 1.5 on business inventories, 0.6 for manufacturers, retailers 1.2, wholesalers 2.5. If we're looking February sorry, January 20, oh, that's January, December, sorry. First column, February over January here, 1%, 0.6, 0.5, and 1.7. So you are having an increase in the value of inventories. Let's look at shipping. Okay, for transportation, we're going to look at two things here. We're going to look at indexes that track cost and indexes that track volume. We'll head over to Baltic Dry Index and then the Freightos Baltic Index. One is for, you know, those big ships that carry iron ore and coal. We'll look at prices for that, and then we'll look at those that carry container cargo. This is for global container freight. We'll look at that index. Then we'll look at a North American index that looks at North American freight volumes. And we'll see that volumes have been dropping off the last little while. We're also going to look at household balance sheets. We're going to look at the net worth, and we're going to look at owner's equity in real estate. And very surprising charts on these ones. Then we're going to get into earnings, but we'll come back to the screen. Let's look at what we have up there. Okay, here is the Baltic Dry Index. You can actually go to the Baltic Exchange, but you're going to need a subscription. There is a free trial period, and I did the free trial for a while, and you get emails every day about what the rates are on a daily basis, and it just seemed like overkill. Unless you were going to arbitrage something or day trade something, it just didn't seem to be interesting at all. So I don't know that you really care about all of that granularity, but at least you know where to find that data. Look where we are, 2137 from we're up 5600 back in October 8th, 2021, and then since then it has been coming down. If you're interested to know what exactly this is measuring, the description is here. The Baltic Dry Index is reported daily by the Baltic Exchange in London. The index provides a benchmark for the price of moving the major raw materials by sea. That's why it's called dry, because this stuff is not oil. So these are not tankers. These are, removing anything that's not wet. The index is composed of three sub-indexes that measure different sizes of dry bulk carriers. Capesize, which typically transport iron ore and coal cargoes of about 150,000 tons. They're called Capesize because they're huge and they can't go through canals. So the Suez Canal and the Panama Canal, they can't do that. So they got to go around the Capes, the southernmost tips of South America and Africa. That's why they're called Capesize. Panamax, which usually carry coal or grain cargoes of about 60,000 to 70,000 tons, it's called Panamax. Because they're the biggest that can still get through the Panama Canal, Panamax. And I believe there's a class called Suezmax, which are the biggest size that can get through the Suez Canal. And then you have the Supramax, which has smaller capacity, and these are meant to be able to navigate the river systems within some countries. So we have the index, which is really coming down, and if we want to see a little bit further back, let's see if we can get as far back as we can, 2017, all the way back to 2017. We had some lows down here. The lower end, 680, almost 700. The upper range here, about 1750. And it's at 2137 right now. Well, actually, that's kind of neat, eh? It was all the way down to, yeah, look at that, 1400, well within the range, and it's been bouncing back a bit, 2137. But the big theme here is you have a real drop off in shipping rates for that. That's basically again peaked in October and has since really started to come down in November, December. There's January, and this is before the crisis in that really started in Eastern Europe. Rates were dropping. Let's have a look at FBX. Here it is here. This is for container shipping. The current FBX 9,232. We saw a peak back here in early September, 11,100. From 11,000, just 7-8 months later, you're sitting at 9,200. There's still a ways to go to get back to where it was back in July, July, August, September of 2020. This was 1913. Don't have anything much before this. You're probably going to need a subscription for this. And then along the side, you have some sub-indices. Here's Pacific. It tells you, China, East Asia to North American, West Coast. It gives you different rates depending on the route that you're looking at. So these are both the dry index and the container shipping rates are both coming down. Let's look at volumes. Okay, so this is the Cass Transportation Index Report. Again, the link is in the website below. And we see our freight index here for shipments, expenditures, and the truckload line haul index. Let's look at the year-over-year change. For March, here's the change for March. Here's year-over-year. The freight index for shipments up 0.6. Expenditures 33.2. Let's do some reading here. U.S. freight volume slowed further in March, with the shipments component of the U.S. Cass Freight Index up just 0.6% year over year, slower than the 3.6% year over year growth in February. Though the shipments component of the Cass Freight Index rose 2.7% from February, this was 1% below the normal seasonal patterns. The year-over-year growth in shipments slowed to 0.4% in Q1 2022, from 4.3% in Q4 21 and 9.5% in Q3 21. 9.5 to 4.3 to 0.4, that's volumes. Does that correspond to shipping rates coming down from September from the third quarter into the fourth quarter into the first quarter? If volumes are dropping, yeah, right? With a few points of softness in Q1 were due to Omicron-related absenteeism. Freight was slowing even before the war in Ukraine began. And last year sometime, I don't even know if it was that long ago, I had mentioned that as the economy begins to open up and as restrictions start to be removed, you'll see a shift in spending from goods back to services. Well, services don't need to be transported. Goods do. And money for people burns a hole in their pocket. They got to spend it. They just have to spend. So if they can't go on vacation, if they can't go to movie theaters, if they can't go to concerts or clubs, money builds up in their account and they say, hey, I can buy this stuff I always wanted to buy. So there was a lot more money that went into goods that could be shipped to your door because services weren't available. And as people are able to leave their homes, go to movie theaters, go to concerts, go to sporting events, enjoy services like they used to, well then at the end of the month when they look at their account balance, they don't have the money to buy all that stuff that they want, right? So it is not surprising to see that that volumes were soft even before the Ukraine war began because money was shifting from goods to services, which is on its own deflationary. And the last the CPI numbers we saw with all those negative numbers sort of supported that. The threat of freight recession has risen recently as services reopen. Inflation presses up interest rates and the war-related effects are likely to be modest in the near term. Higher energy prices have an increasingly negative effect over time. We're certainly seeing a freight slowdown and spot market correction, but in our view, it is too early to call it a freight recession. Using a normal seasonal pattern from March, the shipments component would be up 3% year over year in April and down about 3% year over year in May. So they're forecasting for next month saying we should see something like that. Let's see, here's the expenditures. The expenditure component of the freight index, which measures the total amount spent on freight, rose 1.1 month over month in March, with shipments up 2.7% and rates down 1.6%. Year over year, freight expenditures were up 33%. On a seasonally adjusted basis, expenditures fell 0.2% month over month, essentially unchanged, with shipments falling 1% month over month and rates still creeping higher. So when you figure out how much you're spending on something, it's a combination of price times quantity. So it's why they're talking about the volume of freight and the price of it. On a 2-year stack basis, the expenditure component of the cash freight index is up 70% in March, with shipments up 11% and rates up 53%. The index rose 38% in 2021 after a 7% decline in 2020 and no change in 2019. And I think that's where we're headed back to, is some level where year over year it's fairly constant. Tougher comparisons in the coming months will naturally slow these year over year increases. What are they saying when they say tougher comparisons in coming months? They're talking about base effects. Tougher comparisons in months over months will slow these year over year increases. But just using normal seasonality from here, the increase in 2022 will still be about 25%. And you can the link is in the description box below. If this stuff interests you, there's a lot more here that you can read in terms of looking at the inferred freight rates. They talk about truckload line haul index if you're interested in that. Freight expectations, lots more here. All right, let's have a look at our consumer and households. Here is households net worth. Look at that. Let's zoom in on certain parts of that. This is the great financial crisis. That's not surprising because stock markets drop. That's going to affect net worth if your asset value is going down, right? And same, there was a small pullback in housing prices at the aggregate level. And if you look at this line straight up, it's fairly consistent, fairly constant. This was this little drop over here was the stock market correction in 2018 because of the increase in rates. And then, of course, you had the stock market crash because of the pandemic shutdown, and then straight up. The slope of this line is steeper than the slope of that line. So to normalize it, you can just figure out a growth rate and you can extrapolate it forward to see how much more wealth is here. Household net worth. Why am I not adjusting this for inflation? There is plenty of evidence that the person on the street, very few people actually think this way, but the person on the street does not think in terms of real purchasing power or real spending power. They see nominal dollars. They see their wealth increasing. They don't do the calculation to adjust it for inflation. They see their paycheck increasing, even if it's only increasing in line with inflation. They see the paycheck increasing. They don't do the calculation to adjust it for inflation. So we have to look at how wealthy they feel, because there is evidence that shows that if somebody feels wealthier, they tend to save less and spend more if they feel that their wealth is increasing with their asset value. So stock markets that are rising, housing prices that are going up, consumers feel a lot more comfortable about borrowing on their future income, about spending a higher proportion of their income today because they think, well, look, my asset value has increased over time. That's taken off some of the heavy lifting off of me for having to save for retirement because these asset prices are going up. They tend to look at nominal dollars, not real dollars. So to determine how they feel about things, we look at their household net worth in terms of nominal dollars. Never been higher. Look at that, 142. This is, by the way, this is in millions, so that is 142 trillion. 142 trillion. Let's just take a step back. There's a whole bunch of things that we can look at here. This was the one we just saw, households net worth. And this is under if you search household balance sheet, FRED, you will get this list up. Households, owners' equity in real estate. And have a look at that, right? The massive increase that happened over here. This was the housing crash in 2008, and then up it went. So not so bad. We usually only see these types of pullbacks when a contraction is credit related. This one over here, this was the .com crash. It wasn't credit related. Notice that it didn't, for owner's equity in real estate, there was no effect. This was 1990, which was sort of, you could call it a real estate crash in a way. But it wasn't credit related at all, and not much change in owner's equity, but this had a significant change because it was also credit related at the same time. We don't have a credit related issue on the horizon, and with no credit related issue, there's no reason why consumer credit can't continue to grow, retail sales can't continue to increase, and housing prices don't. You don't see them falling off a cliff, even though they're ridiculously high. You don't see them falling off a cliff. I was looking on the Realtor.ca in my area to see, well, what's listed. Is there an increase in inventory? And there definitely is an increase in inventory. There are multiple pages now where a few months ago, if you got through a page and a half, that was all that was available. Well, there's a lot more inventory now. And I'm looking at some houses that are selling for 1.5, 1.6, and I'm thinking, you gotta be kidding me here. How, like, these things are selling? It seems like a ridiculous price, but if somebody is buying it, yeah. And if you drive around this neighborhood, wherever you see a for sale sign, it's very common to see a sold sign slapped on it right now. And I thought that, my house, in the 3 short years that I purchased it, I think I can get double. I was wrong. I can get way more than double in the 3 short years that I've owned my house based on what's selling and what they have, their square footage and the amenities versus what I have, the size of the lot. I can get a lot more. And here's the thing. If I listed it, I'd probably have multiple offers in the first few days, and it would probably go for more than I'm asking. So, yeah, you have elevated mortgage rates. But it doesn't seem like you have a slowdown in that part of the market at all. I would not expect a pullback in housing prices. And again, at the aggregate level, a whole bunch of things can happen under the surface. Somebody could say, well, no, in this city prices crashed. Yeah, but in this city they didn't, right? It's at the aggregate level. And when we're looking for aggregates, GDP is an aggregate. You look for aggregate amounts. Owner's equity in real estate, look at that level, right? That's huge. Again, this is in trillions. There's 26 trillion. So if you put that up against total household net worth, take 26 off of the 142. That one, the difference, the 116 trillion difference, comes from other assets, because we've already looked at their equity in their home. That's a solid balance sheet. Now, I'm not looking at assets here. You can't say, oh, well, you got to consider the amount of debt that they have. I am looking at net worth. That is assets minus their liabilities. This is their net worth. That is, the value of their balance sheet. I'm not just looking at assets and painting a rosy picture without showing you the debt. This is assets minus all the liabilities. Here we are. That does not look like a consumer that wants to roll over anytime soon. And because they're looking at nominal numbers, they tend to, spend more of their current income than not. And we know wages are increasing. Wages are increasing. The last report we saw for labor, we saw that wages year over year had increased at a faster rate than the core PCE, cost of living index, had increased. All of these things are quite positive. Okay, interest rates behind us. We have inventories and transportation, a deeper look into that, and more sites that you can add to your inventory of data that you have available for free. Now let's move past the economy and let's look at earnings, because you can have a strong economy. You can have wages going up and you can have a very strong economy, but you can have a less healthy earnings environment, meaning that companies, while they're reporting increases in revenues, they're reporting lower margins and lower net incomes, only because employees and workers are now getting a larger piece of the wealth pie, or of the income pie, if you want to call it. And last week I said that I am not against that at all. I see nothing wrong with wages rising for non-salaried workers. It is the best form of income and wealth redistribution available. Don't look to your government to do it efficiently. Taxes are extremely inefficient, and taxes never really go where politicians say they're supposed to go. Never really get there. So higher wages, yeah, I have no problem with that because, to use the fishing analogy, you're restocking the lake with bigger and bigger fish. And if you want to keep fishing in that lake, you got to keep restocking the fish. This is an excellent way to restock the fish. What you don't want is the government showing up, taking half the fish you catch, saying thank you very much. Hey, what about throwing them back in the lake there? What about restocking the lake? No, we'll restock the lake, we'll feed the fish, thank you, and then we'll catch the fish and governments can piss off. How's that sound? So let's look at earnings and what we expect to see. Good news all the way around on this one. The consensus earnings estimate for Q1 has increased because of what we've seen reported already. The growth rate in earnings year over year, excluding energy, has gone from being up 0.6 to now up 0.7 year over year, moving in the right direction. So these things are heading in the right direction. Of the companies that have reported, 9.5% have reported earnings above the aggregate consensus to date. 9.5% have. And we're going to go look at a larger report on this in a second. But let's just let me sum up here. Supportive. The economy and earnings are supportive of higher market values, or at least market values where they are, if not going higher into the end of the year, especially if earnings continue to improve, if inflation continues to give way, if the Fed doesn't get to the target rate of 1.75 to 1.9 by year end because they don't have to. These are all very, very supportive. And these are all things that if I'm looking at the market and I'm thinking, when's a good time to buy? I would think, well, now's a pretty good time. What is the weight on the market against us? Well, you have the war in Ukraine. And these things are non-linear. You can't just say, well, it is what it is and it'll go sideways for a while. You don't know. So, that's still a risk. Rates. The market is, the Fed is not moving that treasury curve from day to day. Maybe their open mouth operations are moving the market, but their open market operations haven't done it yet. It is the market itself moving rates. That's a bit of an issue, especially if we're looking at real rates. How high will real rates go? Real rates are a bigger threat to growth because that now, when you borrow, that now actually has a real cost to borrowing. And of course, you have COVID disruptions. China is adamant about their zero COVID policy and adamant about using their own vaccine as opposed to using, Western-made vaccines that are probably better. So how long that's going to continue for, I don't know. I still think our biggest risk by far, these are risks, these are weights, but you know what? We're adaptive. Businesses are adaptive. Humans are adaptive, that whenever a problem arises, that's a great place for entrepreneurship and innovation and technology to arise, saying, let's work our way around that. These things can be adapted to. Biggest risk is still a policy mistake, is not giving the time for inflation to come down on its own. Wait for these base effects to wear off and you'll see year over year it's not that bad. And everything, all those negative signs are going in the right direction. Inventories are going in the right direction. Yes, we're not there yet, but it's all going in the right direction. So the biggest risk is, let's go 50 basis points, then 50, then 50, then 50, and start thinking, we got to get to 3.5% by, mid next year. We got to get to 2.25, 2.5 by the end of the year. And you push real rates higher, especially on the 10-year. You start getting real rates 50, 60, 70 basis points. That is probably the biggest risk to the market right now, is a policy mistake. Let's dive into earnings here. April 14th, 2022. And I don't know if any of you guys might have missed it before, but our two authors here, the two analysts, both charter holders. So obviously, everything written in this document is absolutely true and precise and is the best source of information you'll ever find, right? I agree. Let's see what we have here. 22 Q1 year over year. Earnings expected to be 6.3%. Earlier in the year, that was 4.8%. And even as low as 3.8%, but energy really had a big run up, so you're up 6.3. Excluding the energy sector, 0.7, up from 0.6. 34 companies have reported earnings to date. 79.4 have reported earnings above analyst estimates. That's a small sample, 34. So let's just, say, okay, well, that's only 34. But still 80% above analyst estimates. Compares to a longer-term average of 66 and prior 4 quarters of 83.1. Revenue expected to be 10.9%, excluding the energy sector, 8.3%. 76% of companies have reported revenue above expectations. For week of April 18th, 69 S&P 500 companies are expected to report quarterly earnings. Do not tell Elon Musk that there are 69 companies reporting next week. He's going to make a joke. I don't know what he's thinking, sitting on a stage making 69 jokes, but there it is. I heard it and I thought, oh, come on. You can't say that. Well, you can say it. I mean, okay, fine, but consider your position and consider who you are. For those of you that didn't hear the joke, I will repeat it. He was talking about the number 42 and his fascination with 420 and 42. And he says, by the way, if you have a triangle which has two angles of 69, the third will be 42. And then he said, maybe there is such a thing as a perfect triangle after all. Anyways. So look at this. This is where we were last week at this little dot way at the bottom, and we were on a staircase down, and look at that. Now we're back up over 434 instead of being down here at just a little over 432. So that's going in the right direction. If we look at, this is earnings versus expectations, it says how many in each sector were above expectations, how many were below expectations. No surprise with consumer discretionary, right? But financials. Now, expectations had been lowered for financials anyways. Part of this drop on the way down was lowered expectations. So the fact that, oh no, let's recover some of that pessimism, that's good. So far, for the S&P 500, for the ones that reported, the surprise factor is positive 9.5% out of the 34 companies. Positive 9.5. And for revenues, positive 1.9. Surprise on revenues. Consumer discretionary, up 0.7. Again, it shouldn't really be too surprising because these are nominal numbers. Revenues are nominal, they're not real. And with inflation where it is, you would have expected, well, lower volumes. You're still going to show revenue growth on lower volumes, but are you going to show, is that going to show up on the bottom line? And with it being 25.1% below the expectations, we're seeing that it is having some weight there. So there we are, 1.9 on as a upside surprise on revenues. I'm not that thrilled about revenues overall. Sure, give me a positive number, but I'm not that thrilled about it. It's what happens below the line. That's important because that's really what trickles down to return on equity, return on invested capital, earnings per share, the amount that can go into dividends, that heads over to free cash flow that gets reinvested back in. So I'm more interested in these sorts of numbers here. Nothing much to see here. You can the link is for this in the description box. So if you want to spend some time looking at earnings at growth rates, this is Q2 expected growth rates quarter over quarter. Let's head down to who's reporting in the weeks coming up. This is interesting stuff. This is positive predicted surprises for the next 2 weeks, April 18th through April 29th. Tesla is expected to report. I think it's Wednesday. Estimate 240 versus a mean of 226. I'm sure they're going to report good numbers. Their sales in the first quarter were strong. I'm sure it'll reflect that. I have a a video coming up, a good presentation on the auto industry where I look at Ford, GM, and Tesla. And I look at where margins are and where margins are expected to go. We look at battery, the trends in the cost of battery technology, investments in EV versus AV versus ICE. And it's, some of the conclusions are a little counterintuitive, but Tesla definitely has margins. It has very good operating margins, very good gross margins. I don't anticipate that they'll miss. They're profitable. They're in the game. The question is, what forward multiple do you want to give them? They are anticipated to make almost $10 per share this year versus just under $5 last year, so 100% increase in EPS. But the 2023 estimate is only $12. It's only up another, 20% growth in 2023, not the 40-50% growth. We'll see. We'll see what happens there, but that's going to be an interesting one. There's a whole bunch of good ones coming up, and the ones that are expected to have negative predicted surprises, none of these are really surprising me. Ford doesn't really surprise me, 37 versus 38, and General Motors is on this list as well, which I wish it wasn't, but it's on this list as well, 164 versus 168. Listen, this is not going to be as important as forward guidance. You can have a company blow earnings out of the water, completely blow it away, but have terrible guidance going forward, and it's going to sell off hard. It's about the guidance. You can have a company miss. I do expect that Ford and GM are going to have tough quarters because we know what their vehicle deliveries were. So the question is going to be, well, what was their average selling price? How much did they sell? How much, what did they get on their financing side? Because they both have, GM credit and Ford credit. What did they get there? Did that make up the difference? Because, model cars are priced high. Interest rates are going up. So maybe they made up the difference there. It's really going to be about the guidance going forward. I expect it to be, you look at the quarter, you go, well, the quarter is what the quarter is. There's really not much you could do. I'm not expecting them to blow away the quarter. It's all about guidance. Big time, it's about guidance. Same with Tesla. It's going to be about guidance. All of these companies are going to be about guidance. Let's have a look at who's reporting. Monday, who are the big guys here? Bank of America is the big one. That's a pretty big one. If you're interested in transportation, JB Hunt. But look at the difference. The estimate 194 a year ago, 137, 41% increase. After looking at what the shipping rates were, even though they've come down from September, they're well elevated year over year. It shouldn't be surprising, right? But that'll be interesting to look at. Tuesday, and over here you could see before the market opens and then after the market closes. Halliburton, Johnson & Johnson, big ones there. Travelers, Netflix, that'll be interesting to see. 290 versus a year ago at 375. Last time they reported, their stock got cut in half, and it really hasn't reclaimed anything above the 375, 380 level. It peaked briefly into the 400 level on a report of somebody buying it, came right back down. It's going to be interesting to see where that one goes. There was a time 3-4 years ago when everyone would say, do you have Netflix? Do you have Netflix? Do you have Netflix? What's that on? It's streaming on Netflix, streaming on Netflix. Now it's, Disney Plus, HBO Max, Netflix, Apple TV. Apple TV's got some really good stuff. By the way, I gotta talk about it. If you haven't been watching Severance, oh my God, the ending. I'm not going to say anything about it, but I'll tell you something. If you're old enough to remember Lost, when Lost first came out, it was super addictive because it was like, what is going on? This is the new Lost, and then some. It's even better because you've got really good actors in here. But Apple TV is hitting big on some of its shows. The morning show, Severance, which is really good. And I have Apple TV, and I can't remember some of the other ones that I watched. Tehran is coming back with season 2 with Glenn Close. That's huge. Lots of good stuff. Ted Lasso, come on, Ted Lasso. So, you look now at well, what's that on? And it's not as easy as saying, well, just Netflix. There's how many different streaming things that you can watch, and you simply just don't have the time in the day. At least I don't know anybody who's got the time in the day to watch all of that stuff. That even if you have one or two, there's so much with that one or two that, how many subscriptions to streaming shows can you have? So I think Netflix will be interesting to watch to see if it is competition proofed at this point, saying, well, you know what, it's cheap enough that everyone will continue to watch it. Who's going to get rid of their Netflix? I don't know. Interesting to watch this one. Robert Half in the employment sector, 146 versus 98. That wouldn't be surprising either that they should beat. Lockheed Martin, watch the guidance on this one. Defense spending increasing globally, at least in the NATO countries. Everyone's saying they're increasing their defense spending. What do we got on Wednesday? Baker Hughes. By the way, if you're interested, there's an app. Baker Hughes has an app for rig counts. So you can follow the rig count in the U.S. every day, and the rig count is reported on Friday. And it gives you an idea of the supply of oil in the U.S. So if you like playing WTI and Nat Gas, you can look at, or Henry Hub Nat Gas, you can look at the rig count. It's got North American rig count, Canada and the U.S. And if you zoom in on certain areas, like different oil fields, you can exactly see where the rigs are. So it'll give you an idea week over week over week how many rigs have been deployed that are actively drilling right now. So if you're interested in that, they do have an app. Procter & Gamble, that's a big one. It's consumer staples, 130 over 126. They tend to be fairly, when the economy does really well, companies like this do okay. When the economy is really bad, companies like this do okay. But when they're bad, they become a defensive play. So money rushes into things like Johnson & Johnson, Procter & Gamble. What else do you have under here? There's Tesla, April 20th. And then United Airlines. That'll be interesting to see. Negative 425 versus negative 750. Delta's already said our volumes are incredible. So let's see what United Airlines has to say. And again, that's not going to be important, the negative 425. It's going to be their forward guidance. What do we got on Thursday here? Union Pacific, more shipping. Some railroads here. American Airlines, Alaska Air, Freeport McMoran. Well, let's see what's going on with minerals, and they're big on copper. And their share price has a very high correlation with the price of copper. Very high correlation. Keycor, Philip Morris for you cigarette smokers out there. AT&T, and then what do we got Friday? Not much, and should all be before the bell. Nobody reports Friday after the bell. Everyone's going home. Schlumberger, American Express. That's the big ones that I can think of. So big week coming up. Margins are going to be a focus, and forward guidance. For Tesla, I would be looking at their margins as well, because they've had increasing gross margins, which means the sale of their vehicle minus the cost of the sale, and they've had increasing operating margins. We know they've increased the price of their vehicle to offset the cost increases they're getting in supply products, especially with lithium, cobalt, nickel. These are major components in the battery. And then they had their shutdown in China a couple of times. I think twice they had to shut down. So it'll be interesting to see what happens to their margins, not just their EPS, but what's going on with their margins and, of course, their forward guidance. Let's have a look at the economic calendar to wrap this up, just so that we can see what macro risks are ahead of us. The big themes for this week, number one is earnings. And as we go through the economic calendar, you'll see it's a lot of Fed speak and housing, a lot of housing indicators coming our way. So on Monday, you have the NAHB Housing Market Index. There's Bullard at 4 o'clock. And then this will be interesting, the IMF World Economic Outlook at 8 o'clock. Next day, you have building permits and housing starts. It's a big week for housing. There is the Fed again, Evans. Then you have mortgage applications. This is weekly, followed by existing home sales. Then you have two more Fed speakers here, 10:30. Let's keep going here. Philly Fed. That's going to see if we can confirm Empire Manufacturing from last week. Leading index. There's Powell and Powell again. And then we have the PMI indexes for manufacturing and for services. I expect services should come in probably better than the 58 forecast. We'll see what happens with manufacturing here. But other than housing, Fed speak, and earnings, there are a few economic reports during the week, but there's nothing really big going on. Earnings are going to be the main event, and then against the backdrop of what the Fed is saying. And this might be a good week to get a very clear picture, or at least as clear a picture as we can, about what we can expect on May 3rd and May 4th on the next Fed meeting. That wraps it up for this week.